provision for bad and doubtful debts. And in this module, we will discuss measurement basis for the provision for doubtful debts. In fact, in the earlier module, we discussed recognition for bad debts and doubtful debts. And we learned that bad debts and doubtful debts are recognized as expense, along with a reciprocal credit effect to the provision, which is contra to asset. Okay? Let me tell you one little thing over here. Normally, when we say provision is a liability, okay, of uncertain timing or amount. As per International Accounting Standard, provision is a liability. But at the same time, there are few provisions which are not liabilities, which are contra to assets, like provision for doubtful debts and provision for discount allowable. So these provisions are contra to asset. Got it? In the same way, provision for depreciation, it is contra to asset. These are not liabilities. If you will consider it or recognize it as liability, it would be a big sin, in accounting. So be careful. Well, when we are saying measurement means to give value. Okay? So when we have to measure our provision for doubtful debt, there are two bases that we normally apply. One is specific and general provision based on expected credit losses. Okay? And the second one is past due or age-based provision. So, both of these two bases we will discuss. First of all, we will discuss specific and general provision based on expected credit losses. How to measure this? Well, we can see this diagram in which we will be working out provision for doubtful debts based on specifically doubtful debtors. Just see, our starting point is the carry forward balance of accounts receivables or debtors. And you know very well there are few transactions in the debit side of sales, cash received, okay, bad debts, etc. And finally, we'll be having a balance carry forward. So provision for doubtful debt is created against this balance carry forward. What do we do? First of all, we see, is there any good debtors in this amount? We will solve a practice question on it, but just see its concept first, then we will solve a practice question on the same concept. So first step is that if we have any good debtor on which we are confident that these debtor will never get bad, what are those, by the way? Those are, in fact, the accounts receivable against we have either a security with us or at the same time they are our accounts payable. Okay. So what we see that if they will not pay us or if we will not be able to recover from us, we will not make payment of their account which is appearing our liability as accounts payable. So these are good debts on which we don't need to create any provision or for which we don't have any doubt of recoverability, minus this. Then comes specific debtors on which we have a doubt of recoverability. Okay? Expected credit loss can be determined or estimated in a certain percentage. So that can be even 10%, that can be 20%, that can be 30%, that can be 40%, that can be 60%, more or less, whatsoever. So I just took 25%, 50%, 75%. So these are the specific debtors on which we have a specific doubt. Okay. Then on third step, there are general debtors on which we will calculate a general percentage of provision. This general percentage of provision will be based on our past experience with the industry or with our specific business entity. So what we see in the earlier diagram, now we will practice through this question. There is a closing balance of debtor with us, 80,000. And we know very well that we have to look into that. Do we have any good debtor appearing in this 80,000? Yes, there is a debtor. There is a debtor whose name is Mr. Phil, owing 6,000. Is also a creditor whom we are the entity, owe 7,500. So the entity owes 7,500 and Phil is owing 6,000. So it means he can never be bad. So Mr. Phil is a good debtor. Okay. Then one of the debtors, Mr. Kill, he is owing 10,000. He is specifically doubtful debtor, and we have estimated that 75% is expected recovery from his estate as final dividend. Means we have a doubt of 25% on it. One of the debtors, Miss Hill, she is owing 6,000, is expected to be doubtful at 50%. We are expecting that 50% can be recovered. And one of the debtors, Mr. Bill, owing 8,000, is expected to be doubtful at 75%. Okay. So general provision for doubtful debt is estimated at 5%. This is based on our experience. So we have to calculate a provision amount for doubtful debts against this 80,000 balance. Okay, this 80,000. And we have to pass accounting entry for increase in provision. We are saying there will be an increase in provision. Why? Because we are assuming that there is an opening balance for provision of doubtful debt equal to 10,000 rupees. So what we see that good debtor Mr. Phil is 6,000, for which we will not create any provision. Specific debtor Mr. Kill, provision is 25%. Miss Hill, provision is 50%. Mr. Bill, provision rate is 75%. Okay. And remaining 50% we will take provision at. So how we calculate this remaining 50,000? By subtracting this 30,000 from the total amount of 80,000. Well, so in a way, we have this 80,000 closing balance against which there is a total amount of provision. We will just make total of these figures. It is a total amount of provision. So do you remember how much was the opening balance of provision? Yes, opening balance of provision was 10,000. It means that closing balance that we have calculated from here is 14,000. It means that 4,000 is the amount of increase in provision for doubtful debts. So here we go. The accounting entry would be bad debts debit and provision for doubtful debts credit. We have already discussed this accounting entry in our earlier module. So the important tips to remember in this module are that subtract good debtors from carry forward balance of the accounts receivable or debtors before calculating any provision. And then sum of specific and general provision gives carry forward balance of the provision for doubtful debt. I trust it's clear to you. Thank you.